Actions 12. And hopefully you're able to both see my face, hear my voice, and in a moment, see the screen that I'm going to be sharing with you. There we go. If you can't do any of that, please chat in and tell me. Otherwise, it's great to have you here, and I'm hoping to tell you a little bit about what's going on with the U.S. markets and how that's going to influence currency markets around the world today. But to talk about what's going on today, it's useful to roll back the clock just a little bit and talk about what happened on January 11th. And that is regarding the CPI numbers, the Consumer Price Index in the U.S. On January 11th, the CPI numbers, which are just a measure of inflation in the United States, were reported by the U.S. Bureau of Labor and Statistics, and they came out saying that inflation, CPI, was running at an annual rate of 3.4%. 3.4% is not super high, but here's the problem. If you look at this chart for where inflation has been over the past several years, what investors and consumers have been used to is this stuff here that's down around 2% on average. And since COVID, of course, since the pandemic, things went crazy. But where we are right now at 3.4% annual is still higher than all of that. And here's the worst part about it. It was, it's been trending down, but it's kind of stopped trending down right here at about 3%. It's kind of hanging in there. And the problem with that is that in order to combat inflation, the Fed started raising rates. And that's why the U.S. stock market was kind of bearish for 2022. In 2023, it sort of recovered because interest rates inflation was going down. And everybody thought that the Fed would turn around and reduce interest rates at some point. Now that inflation is sort of hanging around here, which is higher than historically comfortable, investors and analysts are expecting that the Fed will not cut rates back to a lower level. And investors were really hoping they were going to do that. But maybe they're not, okay? So since this report came out, it's made a difference in investors thinking, institutional investors. And you can kind of see that here on this chart of the euro. If I draw a line here across the bottom, that's a nice upward trend. But it's a trend that we've just recently started to break. And you look at when we started to do that, right? Here is January 11th right here. Since then, this currency pair has moved lower. Hasn't been a lot of days. It's not a big long trend, but it's euro weakness, dollar strength. And is it possible that the U.S. dollar is going to continue to be strong? Because if you have higher interest rates, then that makes currency investors more attracted to a currency that is paying better interest. And if the U.S. dollar is not going to reduce, if the Fed is not going to reduce interest rates, then the dollar is going to pay overnight interest at its current level, which is not terrible, and that would be the kind of thing that would make the dollar strengthen. So Euro USD You've got that small trend just like that. Australian, similar, right? Here is the 12th, or sorry, the 11th of January. And since then, whoosh, from back here, you've got that sort of trend. And, we're maybe bouncing up. So here's the big question. Is this thing, a bounce and it's going to continue back up, going to continue trending? Or are we about to sort of break that upward trend? I mean, this is a strong move. You could draw a line here like that, and then we just fell right through that line based on that news, right? So is this going to continue to trend down that way? Are we going to continue to see dollar strength? Let's look at this, USD JPY. And this has, a completely different look to it, of course, because it has the dollar, the US dollar in front. And this trend had already, this shorter term trend had already broken through, but there it was, January 11th. And since then, whoosh, dollar strength, right? So is that going to continue? Is the euro dollar or Aussie dollar going to continue to trend lower? How would you know? I'd like to suggest that one thing that you want to look at as a currency trader right now is the Russell 2000 index. It's an index of small cap stocks. So the stock market's had the U.S. stock market's had a fantastic run since late October until just recently here. And the NASDAQ, same thing. It's really taking off. By comparison, the Russell has, it's still trending up, but there's a very important subtle difference. Notice that both of these indexes are on their high, but the Russell is not anywhere near. And it's coming down. It started coming down at the end of the year. There's an old saying that small caps tend to outperform at the beginning of the year. In January, they do better than the other two indexes. That has not been the case. And I would like to suggest that the reason for that is the same thing we're talking about. Since even before January 11th, investors were sort of discounting the idea that small cap stocks could do well this year. And if, in fact, interest rates were going to be cut, then this is the place you'd want to put your money. And I think people were hoping that the Fed might say, "Oh, okay, we don't need to get higher and higher interest rates. We can start cutting back a little bit." Because if they did, then small companies would be able to borrow money. Small companies always need to borrow money, right? And we say small companies here, we're not talking about, the mom and pop dry cleaning shop or something. This is still a company that might employ 100 or even 1,000 people. It's just companies that do less than $2 billion worth of business every year, or there's more specifically, it's a company that has, if you take their stock price and multiply it by the number of shares, their market capitalization, that number is less than $2 billion. So that's what this is. The companies that are in that range. So most of these companies, they're not household names. They're not Apple. They're not Microsoft. They're not Tesla. But occasionally, you might have heard of a company that's one of these, but most of the time you haven't. And these companies, in order to expand, in order to create a new product line or to become a medium-sized or maybe even large company, they need to borrow money, and they don't borrow small amounts of money. They have to borrow large amounts of money to do that. And an interest rate difference of borrowing at say 3.5% or borrowing at 7% is significantly different for them. They would take a huge hit to their profitability. And that's why interest rates make a big difference to that index. So you can see this thing was way up. I mean, look at this. At the end of the year, they were up 23, almost 24% during a period of time that the S&P 500 was up only 14%. I mean, both of those numbers are surprising, but 23 compared to 14, that's huge, right? And since then, the S&P has continued. It's gone on to add another couple points to it, but this thing has dropped off from 23 clear down to 16. So it's just like equalized, right? And if you look at what's happened since January 11th, there it is. It looks a lot like, that little bit you see on the euro. It's dipped down. So investors are really expecting that small cap stocks are not going to be able to perform well. This is the chart you want to keep an eye on. And the ticker symbol is IWM. IWM is the ETF that tracks the Russell 2000 index. And my thesis here is that if you're going to see a trend continue in the dollar, right, continue in dollar strength, then it would be also the case that the small cap stocks will continue to either trend lower or at least just diverge from the other two major index. If in fact this breaks and starts going up and starts heading back up to its new high following these indexes, that would be investors thinking, oh, hey, the Fed might cut interest rates, and then you would see dollar weakness at that point. But if you see this thing, continue to struggle with regaining an upward trend, then investors are thinking dollar strength, greenback strength. So I think that that's another clue that you can be using to try to find out whether or not the dollar-denominated pairs are going to continue to break through that trend or maybe resume that trend that they had been on. And so it's good to keep an eye on that because you might see some trading opportunities. What about going forward? What should we expect for the U.S. market, right? Well, I would like to show you this chart. It's two different ideas. Generally, I'll just tell you, I think that we're in for a bullish move. However, there's some reason to perhaps think otherwise. Have a look at this chart. There's a thing called the presidential cycle, and it just maps out the stock market performance on average over the relative 4 years of the U.S. president's term. So in the election year, and then the year after that, post-election year, midterm, and pre-election year. So this year is an election year for the U.S. And so this particular pattern in the Dow Jones Index, which is going to be similar to the S&P 500, it plays out like this. You get the first half of the year heading down and the rest of the year going up. Now, this is a seasonality chart, so it takes all of the chart, all of the stuff that has happened over the past 120 years, right? And every election year it averages those out, and then so forth. We can see that the pre-election year is the best of these four, and that's the year we just came from. 2023 was in fact a pretty good year for the S&P 500, but the election year tends to start off poorly, and then the last part of the year tends to be really good. Well, we're not really playing fully according to script, and we kind of did. We started off little dour, but now we've gone and made new highs. So we're not exactly playing to script. According to this script, though, the stock market would continue to struggle for the first 3 and 6 months of the year, and then after that it would take off and do better. So we want to keep an eye on that. But if in fact we were worried that, that means we're going to have a bear market for the next 6 months, keep in mind this index right here shows that if you started at 100, well, the drop is only like 98. So that's really more of a sideways move. But I think there's a good chance that we won't see a sideways move. We will see, in fact, an upwards move, in part because although inflation is higher than people want it to be at 3.4%, it's not out of control. It's not crazy high. And people need to stay ahead of inflation. And the only way they have available to do that is by investing in the stock market. I mean, you can invest in bonds, but if interest rates rise, bonds fall. And that really burned a lot of people last year, 2 years ago, 2022. And so I think people are, investors are a little hesitant, because if the Fed isn't going to cut rates, and see, remember, we've got evidence that shows investors think that the Fed's not going to cut rates. If they're not going to cut rates, then bond prices are not going to increase. Here, however, is my ultimate reason why I think that the markets are more likely to go bullish for the next several months. And that is that the money, institutional money, that is going into the markets right now tends to be looking for opportunity, not looking for safety. Okay. How do I know that? Well, this chart compares the S&P 500 to the utility stocks sector. Utility stocks are like electric companies and telephone companies and power companies. They're not going to grow. These companies aren't going to grow a lot. They're mini monopolies. They have their customer set, and they pay out dividends, because they have this predictable collection of money coming in, because people rely on this stuff. They got to have their electricity. They got to have their gas power or whatever, right? Whatever the utility is providing. Utility companies they make their money, or investors make their money by holding on to this and collecting dividends from those companies' stocks. All of the utility stocks pay dividends. And so when the market starts looking bad, people who are looking for safety and predictability, they usually put their money in utilities. And investors, professional investors, they tend to really move their money into utilities ahead of a bear market. If we look back here in 2023, right in front of 2023, you see how the utilities really started moving up through 2022. Actually, I got to go farther back, don't I? Yeah, 2022. Here it is here. In 2022, you can see that the red line, which is the utility sector, is moving up faster than the blue line. And the blue line fully starts turning down by January. And so even though they're both turning down, the red line is not going down as far. So the red line is outperforming the blue line at the beginning of 22. This is a signal that flashed right at the beginning of 22. The other is that the average true range, the volatility of that sector, or of the S&P 500, started heading up fast. So that was a really big, bright neon sign saying, hey, there's a bear market ahead, right? Fast forward to where we are now. Sorry, I got to get this chart right. And you can see That's not happening. You've got the utility sector going down. You've got the S&P 500 going up, and they got the average true range also heading down. This is a bullish layout. This says people are looking for opportunity, not looking for safety. In the other case, money floods to the utilities if people are looking for safety. So when you see investors looking for safety, then you know that they're afraid to put money into the indexes, money into growth stocks, and they want to put their money into sort of safe and predictable stuff so they just don't lose money. And that's not what they're doing now. They're moving their money into predictable, or not predictable, into riskier things, into stocks away from utilities. And we don't have the market increasing in volatility. So these are signals that investors are likely to hang around in the stock market, to leave their money there, and maybe even add more to it. The typical U.S. investor participant in the stock market is somebody who has a good paying job, and then they have this savings account called 401k. It's a tax deferred kind of thing. Other countries around the world have versions of this. But what happens in the US is that a large number of people who are working and saving money, when they save their money and it goes into a retirement account, that retirement account has only about 10 choices for where it can put its money to grow. And those choices are stock funds, stock mutual funds, or income mutual funds, which are bonds, or some blend of the two. And so most people who are working and saving money in the U.S. are participating in the stock market. There's a lot of them that don't really realize the extent to how much they are participating in the stock market, but they are. And each 2 weeks, their paycheck takes out a piece and shoves it right into the market. So if in fact people are afraid of the market, then they'll change their elections to, that is their where the money should be allocated to. They'll change it from being into stocks to put it into something safer like bonds, or even safer still like money market funds, which is essentially holding it in cash. And right now, you can see just by looking at the indexes, that's not happening. Every couple of weeks, people are putting money in, and it's adding more and more to stocks. So as long as people aren't afraid, they aren't looking for safety, then the stock market's always going to get a little bit more added to it each year, and each couple of weeks. And that is why I think we're going to continue to see bullish moves, bullish trends in the U.S. stock market. And that typically correlates with a bullish move in the euro compared to the U.S. dollar. But we've got nuances going on there about inflation and interest rates. And that's why I think we're going to see headwinds on the euro trying to make an upward trend. And probably we're going to see dollar denominated or dollar numerated pairs. That's U.S. dollar, Japanese yen, right? Do well. And so before we end up here, any questions, anything I said? I know I covered a lot of information there. I do want to give out a couple of trade ideas, which I think are intriguing. Here in on this chart in the currencies, I think the Aussie yen, which doesn't have anything to do with dollar denomination or whatever, has an intriguing little setup going on. You've got the lows increasing and the highs sort of increasing just a little bit, right? You got this sort of wedge pattern going on. But this morning, we are ready, we're on the verge of breaking that upper line. I mean, we could, probably be a little bit more exact about that right there. Set up to sort of break it the way through. and it looks like there's more resistance there ahead of it. So, coming back down. But eventually, if we keep moving higher and higher and break out into new highs, I mean, this is really an interesting level for the Aussie yen. And if in fact we break above that and continue going, that could make this kind of a move, right? This sort of blue sky kind of upward move. Is it really the case that the Australian dollar would gain that much strength against the Japanese yen? Well, I'm not sure. That sounds a little. That sounds a little. I don't know. A little hard to predict, right? Because what you see here is post-COVID, there's this big move, but we've really tapered off since the middle of 2022 and been sideways. Could it be that there's something that's going to make for a strong upward move, in a multi-month period? Well, here's the one thing I would suggest might do it, and that is that the Aussie yen tends to be correlated to the U.S. stock market, specifically the NASDAQ 100. Tends to be fairly correlated. If the NASDAQ is going to take off and continue moving stronger, higher and stronger, like it's doing right now, then it's very possible that this currency pair could see, something similar. That is a continued upward trend. That this trend right here that has started. Notice when it started, right? March of 2023, when interest rates were, firmly dropping in the U.S., right? So is it possible that we could continue to see the upward trend on the Aussie yen? I think as long as we continue to see new highs on the NASDAQ, it leaves open the possibility that you could see that there. So that's one trade I wanted to show you. And well, how are you going to know that it could, possibly make that? Well, I would also go back to IWM and say, if in fact, so you look at IWM and it's been flat also these past years. If in fact IWM gets going back upwards, right? And if the NASDAQ is going to go strong, well, okay. But how do we know that the NASDAQ or the S&P 500 are going to move stronger? We don't. They could always move. They could always go up. They could always go down. However, if the small caps turn around and find their way up to a new high and heading out that way, if even the small caps are bullish, then these ones here, the large caps, they're going to be even more bullish, right? So I feel like, again, if you're paying close attention to this particular trade and watching where it goes, then you can get an early precursor on whether or not the Aussie yen might also make a similar move. And so if you're looking at stocks here in the IWM, in the Russell 2000, and looking for a stock that might do a good job in small caps, it's easy enough to go to ETF database and type in IWM and to say, what are the stocks that are really kind of driving that ETF or the Russell 2000 index? And just check out the top holdings of the Russell ETF. And you see these are the stocks. These are the top stocks that are really moving things. SMCI, CHX, and so on and so forth down this list. Any one of these, this one here, SCMI, notice how big it is compared to all the others. That's probably because it's had a huge run up. And so if I were to go to there and do SCMI, I'm probably going to see it. The SMCI, got those backwards. SMCI. This huge move higher, see? And this is, wow, it's just a daily chart. So this thing really took off. And it's had a great run over the past year. But hey, look at this. See, sideways, and then now all of a sudden boom, it broke out. Small company doing probably computer chips and stuff, right? Technology is the key item there. And technology is associated with, correlated with the Aussie yen. Could this be an early indication of what the Aussie yen is going to do? No, we're not going to have this huge big day on the Aussie yen. But if we break out, it could be a strong multi-day trend that would break out to new highs. Okay, great. Lexon said no. I assume that's no, you don't have questions. Thank you for letting me know. So I really like the idea of watching this stock and other stocks like it. This one here, it's $420 stock. Okay, I would love to have bought it here at 320 and captured that, right? But what other stocks are there that you could see growth with? Well, stuff down this list is probably a good candidate. Go down the list and find one that has that's not as expensive. Let's look at this really quick here. This one, MUR. Okay. This is an oil company, and the price of oil has been falling, and so that's why this thing has been going down. But it's also possible that in the election year, you're going to see pressure on the price of oil because people pay attention to what the gas prices are, right? On the other hand, we've got earnings coming up, and investors are not expecting this company to have done well. But hey, last time that they reported earnings, they had quite a surprise, overestimate surprise. Investors are expecting, let's see, they reported 959 million. Investors are expecting their revenues to be way down, like 15-20% lower than last time around. But that's an easy bar to hit. That it could be that this company is going to outperform, and that we could see a good move. And of course, it's only a $38 stock, so lots of room to grow here. $38 to $48. It's the same thing, kind of, as 300 to 400, right? 20-25% growth for this thing to get back up to a high. And then this one, Novanta, NOVT. Yeah, well, it's pharma stock, and it's way down there at 125, and I don't know. If in fact the Russell is going to turn around, though, this is working on that same pattern. It goes up, it's kind of pulled back on kind of a flag pattern type thing, and if the Russell breaks out, this thing will probably break out too, and could have a nice strong move back up to its old highs. But like I said, I think investors are wary of that, and they don't believe that Fed's going to give them good rates. So I would be more interested in taking my chances with MUR rather than with NOVT right now. Okay, well, with that in mind, I hope that this gives you some good ideas of things to watch, and particularly in ways in which the U.S. stock market can help you inform your currency trading choices. Pay close attention to the IWM chart and over the next several weeks, and I think it will give you a good a good source of information on larger macro trends that are going to play out in the currency markets. Yeah, you're welcome. You're welcome. Thank you for anybody listening who liked that, and I hope that this gives you the opportunity to take care and trade well going forward. Until next time we do this in about a month, we'll see you then. Sorry. Let me just say really quick. If any of you are considering going to Bali, I will be there. Really looking forward to meeting you guys. All right. Take care.